This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello, welcome to this week's episode of the AJ Bell Money Markets podcast, and what a week it's been. So joining me to discuss the FTSE's run of record highs, Netflix's record subscriber numbers, and the latest UK public sector borrowing figures is Danni Hewson. Hi there, Danni.
Hi, Dan. Yes, you're absolutely right. It's been quite the week. And of course, it has been dominated by one Donald J. Trump's return to the White House. And I know you've been getting all the info on how markets have been reacting from AJ Bell's investment director, Russ Mould.
And we'll also discuss a change at the top for the competition watchdog and how the government's focus on economic growth has put regulators on notice. And one impact could be a change in mortgage lending criteria. There's also talk of a higher limit for contactless card shopping. Now, speaking at Davos, Santander's boss has also denied the bank is thinking of leaving the UK. We'll have all that later in the podcast.
We'll also discuss why two broker notes had very different views on Greggs as an investment, and more boardroom shenanigans as Fraser's bid to oust one of Boohoo's founders didn't get shareholder approval. Plus, we hear from James Flintoft, Head of Investment Solutions from AJ Bell, about changes to asset allocation in AJ Bell funds.
So, lots of things to dig into this week on the podcast. I think we've got to start with Donald Trump's return to the White House.
Yeah, funny, isn't it, that we kind of forgotten the volatility, the whiplash that investors felt during his last term because of his unpredictability and the fact that, he'll have a set piece and he'll say something and people think, well, that wasn't in there. And then off the cuff comments straight afterwards and suddenly that appears. So it has caught people on the hop who thought it might be different. Well, I think they were deluding themselves. And I know that you've been chatting to a man who always has his finger on the pulse.
Russ, thanks ever so much for joining us on the podcast this week. We've got to talk Donald Trump. We've got to talk about market reaction to it. I mean, obviously, when the election result came out last November, markets got quite excited. That lasted for a bit, and then markets sort of pulled back a bit. How did his inauguration sort of influence markets this time?
Yeah, I mean, the Trump bump in equities, I think, was related as much to relief over corporate tax rates not going up and tax breaks being extended. That's run out of a little bit of steam, as you say. The dollar's continued to rise, and Treasury yields have continued to rise, and therefore US bond prices continue to fall. So you're getting a slightly different perspective from depending which asset class you're looking at. But in terms of the actual inauguration, Asian markets seemed relatively calm. The dollar gained a little bit. I don't think there's been a huge amount of response because people are still trying to work out exactly what the president's got in mind and whether a lot of his positions are just a bargaining counter.
Yeah, I mean, tariffs were clearly talked about during his election campaign, and then when he got in, everyone knew they were coming. So when we had the inauguration, we saw the first round of executive orders. They weren't on the list, which was quite surprising, but that didn't mean he ended the day not talking about them.
No, threats of big tariffs on China continued, where it seems that TikTok may be one of the bargaining chips that's in the conversation, and also Mexico and Canada very much in the firing line, potentially from the 1st of February, pending again executive orders and what response he gets. Trump threatened France and Mexico with tariffs during his first term, got some concessions, went away and changed tax. So I think to a degree, that's what equity markets are looking for or hoping for is a relatively benign solution there.
I mean, with China, he talked about 60%, but now, like you say, TikTok could be a bargaining chip. He's sort of saying, well, if you don't agree to sell half of, or I presume it says half of TikTok, I presume it's half of TikTok's American operations to a US company, then I'll come and impose up to 100% tariffs on China. I mean, this is, that would be catastrophic, wouldn't it, for China if it had 100% tariffs into the US?
They wouldn't be very pleased in that, they have had an economic model that's been heavily based upon exporting cheaply made goods and then domestically, boosting real estate, housing, And both of those are now coming under extreme duress. So they're going to need to try and boost domestic consumption as best they possibly can. It would be a major challenge for them. Equally, Europe, is in the firing line. He talked yesterday about Europeans not buying enough American cars, not buying enough American oil, and not buying enough American agricultural products. On the cars, by the way, just make some nicer ones and people might actually be interested. So that's probably the solution there. But again, Europe is in the firing line. The UK, not so much, because America runs a trade surplus with us.
Yeah, I mean, the idea of tariffs, I mean, Donald Trump was saying, we can collect lots of revenue from all these tariffs, but surely it's the companies who are buying goods from abroad are the ones who pay the tariffs. Is that correct?
The Treasury would collect the money.
Yeah.
So in that respect, that the tariffs will be paid, the Treasury will collect the money. And that is one of the arguments is it will help bring America's ballooning budget deficit under control, which would be a good thing if indeed were that would be a positive offshoot. Equally, will there be 100% collection? No. Will there be complications in that you'd assume that Americans would perhaps look to buy cheaper goods and therefore not buy the expensive imported stuff? Probably. But then equally, Trump will argue that's a positive because an American domestic output may be used to compensate. So he's trying to say, look, tariffs will bring us in revenue, they will drive domestic production, they will drive local employment, and we will find out. I mean, there's a suspicion that deep down that tariffs will be inflationary, but if people stop buying the expensive goods and buy cheaper domestic stuff, that might not be the case. So we'll find out over time.
I mean, obviously, on the subject of sort of affordability and prices for people, he did say, I want to make things cheaper for Americans. But yet, the first thing he did was talk about clamp down on illegal immigration. So that could essentially affect the pool of workers, either who are prepared to do menial tasks, or certainly in areas like agriculture and construction. So if we suddenly find we've got a much smaller pool of workers for these industries, that would imply companies would have to pay more to hire these people, and that they're just going to pass those costs on to the consumer.
I don't want to stir the pot, but there's an element you could argue that's been happening in the UK post-Brexit, and some farmers have expressed considerable concern there, and the UK is now seen as having a bit of a sticky inflation problem because wages are proving relatively firm. And in fact, we've just seen some strong UK wage growth numbers this week. So it is a risk. I think, again, on the tariff side, yes, you can make things more domestically and employ more people, but people in Chattanooga are an awful lot more expensive than they are in China, generally speaking. So yes, there could be an inflationary impact of that as well on a secondary basis.
I mean, so just generally, we now know the lay of the land, but we don't know the lay of the land, do we? Because we've got some indication about what he wants to do. Obviously, tariffs, we'll get more information as the weeks progress. He talked about defense wanting to, basically make America sort of this much bigger, stronger power. But I guess it all comes down to how is he going to fund all this stuff? You're going to have switching around budgets. It's from an investment perspective, I guess, are we just expecting markets to be very choppy for months to come? It
seems a fair bet. I mean, again, you're probably hanging on his every word probably isn't a smart thing to do, given that he's feeling his way and again, he's perhaps looking for a deal. He will argue tariffs will generate tax dollars. He will argue that deregulation will help and that both will stimulate growth. And if you want to get your debt to GDP figure under control, growth is definitely the best way about it. And that's what Chancellor Reeves is trying to achieve in the UK. Equally, if there was a lever in a wall that you could just pull and get it done, I think it probably would have been pulled by now. But nevertheless, that's what markets are looking for. And they're pricing in America, not in the UK. They are pricing in ongoing strong economic growth and ongoing strong corporate profits growth. So if for any reason he doesn't deliver, that could be interesting.
Just want to ask you one more question about Trump being sort of his role and his perception of how he's perceived by the business community. In his inauguration, we saw, there were leaders from Meta, Google, Tesla. This is quite interesting because I got the sense that with Joe Biden, he wasn't particularly embraced by the business community. But obviously, are they all sort of trying to be best friends with Trump now because they think it would help them?
Given that the Republicans control the White House, the Senate, and the House of Representatives, he's in the box seat, which Biden wasn't to the same degree. And equally, philosophically, Biden was the one that was talking, and Kamala Harris were the ones talking about jacking up corporate taxes. They already put taxes on share buybacks. So they weren't seen as being, I guess you could say, as business friendly as the new president, Donald Trump, is. And I guess that's why they're there. And also, They have vested interests. They're looking at deregulation. There was huge regulatory pushback under the Biden administration from the Securities and Exchange Commission, for example. Gary Gensler's now gone. So I think in that respect, they are hoping for an easier ride from a regulation perspective under Trump than they got under Biden. I guess what you could say there is deregulation under Reagan worked really, really well in terms of promoting competition, reducing barriers to entry. What it didn't do then was reduce quality of service, allow cost cutting and allow corner cutting. So it still kept consumer protections. And that's really what deregulation is all about, is better supply, which can be lower prices, but while the quality and the protections are the same. If you're just talking about it being aces wild, then really you've got robber barons in charge. And I'm not sure that's necessarily a good thing over the long run.
So amidst all the pomp, tariff concerns, and yes, a little bit of confusion, London's blue chip index has closed at record highs for 3 sessions in a row. And we're recording this lunchtime on Wednesday. And earlier, it touched another fresh record, although it has dropped back a little bit since then. But a lot of this is based on the fact that when we're talking about the FTSE 100, a huge proportion of the companies that are housed there have their earnings generated in dollars. And of course, the dollar has been incredibly strong with the expectation of those tariffs that you were just talking about, that the Fed wouldn't be able to hike rates as far or as fast as many people had thought just a few months ago. And because of those earnings generated in dollars but reported in pounds, that means that a lot of those FTSE 100 companies start to look much more profitable. You've also got the situation, of course, where foreign investors buying in dollars are finding that shares are looking particularly cheap when the pound is low. Now, we have seen the pound really quite subdued. It didn't get down anywhere near to the levels that we saw following the Liz Truss mini budget, but it's been at 5-month lows at 123 against the dollar. And this, of course, is also coming because a lot of people are now thinking that the Bank of England is going to have to go further and faster in cutting interest rates. And of course, when interest rate gets cut, that usually devalues the currency as well. And in fact, just today, we've had an update from Goldman Sachs taking a look at where they expect interest rates to go. Since we had the inflation data out last week, markets have been really pinning on the expectation that we would get 2 cuts, February being the first. Well, Goldman Sachs reckons that the bank's going to have to go a lot further than that, really step up the pace, and in fact anticipates that interest rates will fall to 3.25% by mid-2026. There's a lot of moving parts here, Dan. A lot of this is down to the fact that the dollar's incredibly strong at the moment, the expectation of what is going to go on globally, particularly with the United States. Obviously, we've seen an easing of tension in the Middle East as well. But I think there is quite a bit of homegrown concern built in there as well, not just in terms of borrowing costs, but just looking at the way the UK economy is. We had jobs figures out earlier this week, which showed unemployment was up. We saw vacancy rates falling again, and the number of payrolled employees dropping back considerably in the wake of this budget that we have just had and those national insurance changes which come in April. We have seen a surge in borrowing costs, and that is one of the things that we noticed this morning when we got public sector borrowing figures, because they had more than doubled this December's borrowing compared to December last year, and a huge proportion of that was down to interest repayments. Now, we have seen a lot of volatility, a lot of concern about the high levels of public borrowing in the UK from the government. There's been a lot of pressure on Rachel Reeves to demonstrate what she is going to do, whether or not she's going to be able to stimulate the growth that we've all been talking about, or whether or not she might have to rein in some of her ambitions for spending. And we've seen a lot of jitters in markets, but not much movement in terms of gilt yields this morning.
No, I think we've had a couple of weeks of gilt yields sort of being on the move, whilst the public sector borrowing figure was way higher than forecast. I don't think anyone's surprised. I mean, it's kind of this situation where the government says we want to get the public finances in order. We also want the economy to grow. Well, it seems clear they're not going to be able to do both at the same time. So I was quite surprised on one hand that the bond market was fairly calm on what seems to be pretty shocking news. But you just have to remember that the market's forward looking, and it's all about pricing in what it thinks will happen, not what has already happened. So I mean, obviously, it's a strange thing. We talk about this sort of concept quite a lot with the FTSE 100. We're also talking about hitting record highs. There's a strange concept there where you say that actually one of the key contributors is sterling weakness. There's someone thinking, like, I don't understand, but the currency of the country that we're talking about, stock market, the weaker it gets, the better it is for stock market. But it's just once you get your head around how these sort of moving parts work, it does become a little bit clearer, really.
It does. And I think one of the things which markets are also looking for at the moment, they've given Rachel Reeves a bit of a reprieve because she came out in the Commons and she said, look, we are going to stick to the fiscal rules. We're not going to raise taxes, but we do want to stimulate growth. And markets have gone, okay, right, well, now show us the plan. They want the meat on the bone. And she's currently at Davos at the moment, where she's obviously discussing potential investment with, the glitterati that is at Davos. And there have been a lot of rumours about what she might say in the coming weeks. And Bloomberg was reporting that she's going to give the go-ahead to the third runway at Heathrow, also for the second runway at Gatwick to be utilised as well, as in addition, sort of extra capacity at Luton too. All of these things are part and parcel of her plans to stimulate growth. And one of the things which has been front and centre really over the last week was regulators. We know that regulators were sent a letter before Christmas asking them to come up with ways that they could help the UK economy grow, to not be a barrier to growth. And it's clear that some of the responses that they got, they weren't particularly happy with. And there's one really important story which has caught a lot of people's attention just today, and that is the Competition and Markets Authority, a watchdog that, really looks out for people in the UK, polices big companies to make sure that competition is a level playing field for people and protects the interests of the consumer. Well, the chair of the CMA is out, Marcus Bockering, and in his place is now a name that might be familiar to people on this podcast, Doug Gurr. Now, he was the man who ran Amazon in the UK until not that long ago. And this appointment is being seen by lots of people as an indication that the government want to have a real dialogue with business, that they want to put growth really at the heart of things, but a lot of questions about what the expense might be, because there was a situation just a couple of years ago where Microsoft, its bid to take over Activision Blizzard was blocked by the CMA. And at the time, Microsoft were quite vocal about the fact that they felt that the CMA's actions kind of took away from the fact that the UK was trying to be a destination for technology businesses to invest. Now, although that was worked out and, the words were much nicer in the wake of the deal being approved than they had been at that time, I think a lot of people were sort of taken aback by the fact that the CMA was willing to go toe-to-toe with these big tech companies. And at a time where Donald Trump is saying in the United States, we're going to have light touch regulation. We're opening the doors for investment. And he had all of his tech bros lined up at his inauguration, sort of a show of power. I think the UK is trying to fall somewhere between the US and the European Union in terms of regulation. And it's going to be a fascinating space to watch over the next couple of years.
Yeah, I mean, obviously, for the last, since November, a couple of months, markets have been excited at the prospect of Donald Trump coming to power because they're all saying, "Oh, he's great for business. He's making, he's making regulation looser. He's probably going to sort of allow more M&A deals." So everyone's got excited. It seems like the UK is definitely sort of taking a look and go, "Oh, perhaps we could do that as well." So it does, Rachel Reeves is already, clearly she's under a lot of pressure. But, just this week, we've had an indication that the Treasury is sort of trying to sort of meddle with what's going on at the moment with sort of mis-selling case with car loan providers. It seems that the Treasury sort of gone down very strange step of intervening in a forthcoming Supreme Court case. It's worried that banks and other lenders could face a really big compensation bill. HSBC analysts reckon that this total cost of potential compensation could reach £44 billion. That's almost on the scale of the PPI scandal that we had a while ago. So I think what the government wants to do is to try and stop the banking sector essentially being derailed and facing all these really, really big compensation things, basically saying any remedy should be proportionate to the loss actually suffered by the consumer. And I think it plays to the sort of the broader theme that the government wants to make things easier for things to happen to drive this economy. So obviously you mentioned earlier, Danny, about how we've already had some indications that the Treasury and the broader government has been sort of talking to businesses saying, what can we do? I find it very interesting that they've gone to all the essentially the gatekeepers. They've gone to the regulators and asked them what can they do. It seems to be, would that be the most logical place to start? It's almost like that, wouldn't they go to someone else to think, where's these great ideas, and then go to regulators and say, like, what do you think of this and stuff? But we've definitely had lots going on. And the FCA has obviously come out and it has actually warned that loosening regulations might result in higher risk taking. And of course, that could see to more frequent failures. So it's pushing for a balanced approach to form. But actually, the FCA is one of the sort of things that's been in the news this week about what could happen to improve the property market and changes to payment stuff. So Danny, what's been going on there?
Yeah, I think there was quite a lot of surprise that there wasn't more said in Rachel Reeves' budget about house building, but more about helping particularly first-time buyers get on the housing ladder. In fact, the only big change which was in there about housing were changes to stamp duty, which actually could be a barrier for a lot of first-time buyers looking to get on the ladder. Now, one of the things which I've heard time and time and time again from people looking to buy a house is we're paying rent. We can afford to pay rent. We've been paying rent for 2 years, 3 years. We pay it every single month without fail. If we were to get a mortgage, our payments would be lower and we would have a house that we're working towards owning, and yet we can't get on the mortgage ladder because of lending criteria. So that's what you've got on the one hand. And at the other hand, as you say, you have this lending criteria which was tightened up in the wake of the 2008 financial crisis. And it's trying to find a way to balance those two things, to be able to help people get on the housing ladder. A lot of people think that that tightening of criteria went too far, because now it's really difficult for a lot of first-time buyers to get on the housing market. And the FCA is looking now at a pretty big shake-up of that, which could help first-time buyers get on the ladder. So at the moment, there's a limit on how many large mortgages that lenders can approve. So they can have no more than 15% of their mortgage book, which can be for loans which come in at more than 4.5 times a buyer's annual salary, which for a lot of people now, particularly in places like London, it's really hard to have an annual salary, which is 4.5 times the average house price in London. Another thing that they're looking at doing is allowing potential homeowners to use their rental payments as a sort of measure of their ability to pay for these things, and also changing the affordability rules, where at the moment they look at how well a borrower could weather a huge change to interest rates unexpectedly. And that could be altered as well. But, there are concerns that some of these things are working just at helping homeowners be able to afford more and more expensive houses, whereas everyone is saying that what really needs to happen is we need more houses built. And certainly we know that's one of the things which the government is looking at. It's reintroduced targets, and it's looking at really sort of smoothing the way with planning reform to try and get more houses built. But it's a difficult one, isn't it? Because if you help more people buy more expensive homes, then homes just going to get more expensive.
I think while we're on the subject of sort of finance and banks, lenders more broadly, I thought it was worth touching on the thing we mentioned earlier about there's a lot of chatter about Santander potentially pulling out of the UK. I'm sure it's devastating for lots of listeners who the prospect of Ant and Dec no longer being on a, those bizarre adverts that they do for Santander. But I think it would be quite a significant move. And obviously, the boss of Santander, Spanish bank, has denied this at the moment. But I think that given the scale of press coverage on it, you have to think that there must be something to all this chatter. So Santander has been in the British market since 2004. It bought Abbey National. It then bought Alliance and Leicester, and it bought the savings arm of Bradford and Bingley. So it's a really big name. It's spent a lot of money trying to get its brand out there. I think that it's essentially just looking at the UK, and there's the suggestion that it's just thinking, well, not sure that the returns are what we want. We're just not. It's not. From an economic point of view, not sure what's going on here. Now, obviously, it sounds quite alarming if you have, what is the fifth biggest bank in the UK potentially pulling out. But you do have to look at some of the other banks, and they're kind of a lot of them are going down the sort of same path. So particularly HSBC has been pulling out of various parts of the world in recent years. This idea that companies, they focus on the areas and the customer types that make them the most amount of money, and they sort of pull out of other things, and they'd be more focused. And it's just a natural sort of way we see this. When things are good, when the economy's thriving, they're quite often happy to expand into other countries and make acquisitions. When times get harder, or certainly uncertain as they are now, they often retrench. So I guess if you're a Santander customer, if I'm going to say, must stress this, there's no confirmed news it's pulling out of the UK. If it happens, it would simply sell its sort of mortgages and essentially all its assets to someone else. Another bank would essentially take over. So if you were a mortgage customer, essentially you just have someone else would be administering your mortgage. If you're on a fixed term, all those sort of conditions and the deals would just continue as normal, as if it was still Santander. If you're a savings account customer, you might be put onto a different deal if you're not on a fixed rate thing. If you're a current account customer, essentially, you just be switched over. And if you're not happy, there's a current account switching service where, obviously the bank will pledge to transfer all the deposits, direct debit, standing orders within 7 days. So it would be a small nuisance, but it wouldn't be the end of the world in terms of your from a personal perspective. But it's more about representing what's going on in the UK. Rachel Reeves would be devastated if one of these big banks decides the UK is no longer worth being in. what sort of message does that send out to, I guess, to the rest of the world? So obviously we'll update you when we get some more news, if anything else does come in.
Just rounding out our bit on banks, how often do you use your contactless payment card, Dan?
Well, increasingly, seemingly all the time. I have, obviously trying, going into the modern world, and I've managed to put my card on my phone. But I do find every time I get, probably one or two in every 3 transactions, the phone it doesn't work. So maybe it's the user error. Don't know, but
I have a huge issue with using my phone for payments because my phone now wants to see my face in order to give it the go ahead. And I'm very short, and a lot of places have their payment reader thing quite high up. And I feel like I need a box to stand in so I can lean over so it can see my face. Because a lot of the time it's just like, no, it's not you, which makes it quite tricky, which is why contactless is brilliant. But I am quite happy with the £100 limit. There has been speculation that limit might be raised or abolished altogether. And that is also in a bid to stimulate growth. But how many times do you use your card and actually need to spend over £100 on it? Because if you're making big purchases, quite a lot of the time you're doing that online anyway.
Yeah, of course. It's worth clarifying. This is £100 before you have to put your PIN in. So it's the stumbling block when you're making a transaction. No, but you're right, aren't you? It's not like you go into a shop and go to a pub and here's a round of drinks. 100 quid on a round of drinks. Like you'd be devastated if you had to pay that.
If that's what you're paying for a round of drinks, Dan, I'm coming out with you. Look, let's move on now to something that I am more than happy to pay for, but I must admit I am happy to go with the ad-supported version, and that is Netflix. I have to say, in this house, we would be lost without Netflix. And it's peculiar because at the moment, we're so caught up with what is going on with Donald Trump and, global economy that we kind of almost lost sight of the fact that we're hip deep in earnings season. And this would normally be a time when we're getting really excited about some of these numbers. And Netflix delivered some numbers to get excited about. So it's seen subscriber numbers jump up once again significantly. And that has meant that it has felt secure enough to put up prices in the United States, in Canada, Portugal, and Argentina. At the moment, it says there's no news to share right now in terms of whether or not it will put up prices in the UK. The last time it did that was October 2023, but then that was the last time it put up prices in the United States and has decided now that it's going to hike them once again. Now, it's moved into a lot of live sport. I am not a boxing fan. I did not watch the Mike Tyson-Jake Paul fight. I don't think it's quite on your viewing list either.
No, I did not watch it. I mean, to be fair, like many households, we have a Netflix subscription, but my kids tend to be the one that watch it, not me. But I have been watching it recently. But the idea of live sports diversifying into something else apart from TV and film, it totally makes sense. What I thought was really interesting when you look at the commentary around the latest numbers from Netflix is that it really hammers home saying, we are not going to start bidding to get the rights for a whole season of, let's say, football or something like that. Obviously, the sports rights are incredibly expensive, but if you have these rights to special events, things that people like thinking, okay, we had a really big boxing match for Christmas and stuff. Everyone was talking about it. Everyone, and Netflix says the response is really good. So it's these big moments that everyone talks about at work or at home or in the pub and stuff. It gets people to watching. If you're not a subscriber, it's another reason for you to potentially get a subscription. Obviously, if you're an advertiser, you want to be parking your promotions against these events, because the audience figures could be pretty good. So it totally makes sense. Now, Netflix does talk about it's also doing gaming, and I think lots of people forget about that. I've got to say, it still doesn't look like they've got the strategy that works. Some of these figures are, they quote are fine, but they're now saying, okay, we're going to focus more on our intellectual property. So, that's all their big shows. They're saying things like Strange Things, Squid Games. You'll have games using all those characters. And I guess that makes sense. They've talked about wanting to sweat their assets, i.e. sell a load of merchandise with these characters on them as well. So doing games and that stuff is fine. But overall, Danny, it sounds like you were pretty impressed with what they're up to at the moment.
Yeah, I am. And I think investors were as well, because post close of Wall Street last night, shares were up 14% in after hours trading. I think the one thing that they said, which sort of struck a chord with me, is that they want to continue to invest. And certainly when you think about the live sporting events that they're putting on now, and some of the technical issues that they have been beset by when doing that, not having the server capacity, clearly that is somewhere that they are going to have to invest, because people are only going to be prepared to pay more to sign up for these big events if they can actually see them, if they're not being hit with buffering, because, buffering, is so last century, isn't it? So, yeah, I think they've got the right stuff now. A couple of years ago, we were talking about the fact that they were losing subscriber numbers, that they were really struggling with content. We had, obviously, the pandemic, which really hit production. We've had strikes in Hollywood, again, that hit production. They're now firing on all cylinders, and they've got a really decent back catalogue. They've got a fantastic stable that they just keep adding to. And as you say, they are, titles that strike a chord with lots of different people from lots of different backgrounds. They've got some fantastic foreign language material on there, which my kids absolutely love. So I think if they can just keep up the momentum, then people are willing to pay for one, maybe two subscription services. And Netflix needs to make sure that it is always people's first choice.
Well, I think it's fascinating how those shares have absolutely rallied off the figures. What I really wanted to talk about this next company on the podcast this week, and actually, it seems I'm not the only one who's casting an eye on it. Greggs, the shares are down this year. This is the 22nd of January recording this. Already this year, the shares in Greggs are down 25%. It's huge. This is a company everyone's going, oh, we love Greggs, love the sausage roll. What's happened is that the market started to become really worried around a growth slowdown. These shares are really highly rated. When a highly rated company delivers bad news or disappointing news, the shares get hammered. That's exactly what we've had here, and we've seen it quite a few times before in the past with Greggs. Now, I thought I'd have a quick go back and just check when this business changed, because I think people still know it as Greggs the Baker, but actually, when Roger Whiteside joined as chief executive in 2013, the business changed its focus from a bakery to a food on the go. And since then, 2014, it said, we've now selling £1 million worth of coffee every week. 2017, it opened its first drive-through. And then 2020 had a first home delivery via Just Eat. So obviously since then, you've got lots of stores in motorway service stations, train stations. So of course, this is really big growth opportunity. So investors were prepared to pay more to own those shares. We try not to use technical stuff on the thing, but for more experienced investors, just to fill you in on this, typically Greggs shares in the good times were trading on 22 or 23 times expected earnings for the next 12 months. that rating has now fallen to 15 times. And of course, that it started, for a stock like this, that pricked up the ears of various investors. So we've had two analyst notes come out this week. One is saying you should buy the shares. One says you should sell the shares. And it's really interesting how totally polarized views. Now, the first one is Panmure Liberum. I won't go into the full details, but essentially they're basically saying they don't think that growth will speed up again for a while. They're really worried about evening trading and delivery because these are meant to be key cogs for future growth. They think that its evening trading is waning, and they're really worried about Greggs generally being sort of lost now in a highly competitive market. Shore Capital come out and said, look at this fall in the share price. We think it's an opportunity to buy high quality business on a more attractive valuation. Yes, it's got some short-term headwinds, but actually, this is a business that has delivered over and over again. In perhaps 3 to 5 years, it could even be an international story. Now, it's really important to stress we don't give investment recommendations. I'm just talking about what these two brokers are saying because their notes are really important. Now, certainly we won't give our personal views on what we think about whether the shares are worth buying at the current price. But I did take a look at the market reaction to these two notes, because normally when you get sort of punchy notes, either big sell or a big buy note, they do influence the share price. Now, it's really interesting to notice that shares in Greggs have not moved much at all on this. They stayed very weak, which would suggest that investors might be sitting in the camp of Panmure Liberum by being very cautious about what's going on. But it is interesting. And I guess, Danny, when's the last time you popped into Greggs to get some sweet treats?
Less the sweet treats, more their pizza slices.
Yeah.
That's absolutely one for me. And it was only a couple of days ago.
Oh, dear.
I love a Greggs. The kids love a Greggs. It's a value lunchtime offer that I know they're all going to eat. And there's one up the road. So it's easy for me. And also, I have to say that of all the travel places that you can stop off at, they do the best tea. So, that for me is it.
Yeah. Oh, well, I can actually guarantee there'd be lots of people listening to this podcast who will agree with you that it's reliable. We're getting, it's not very expensive. I guess we're in a very difficult situation at the moment. Lots of retailers, very gloomy outlook if you read their updates in recent weeks. And I imagine we'll probably take a closer look at sort of rounding up what all the retailers have been saying in one of the podcasts in the next couple of weeks going forward. But yeah, definitely, I thought that was a really curious one to get your head around and what on earth is going on there. That one. I think we also, Bob, on the subject of sort of retail, I know you've been looking at Frasers and Boohoo. We've got a bit of an update there.
I had to mention this because this boardroom blitz that's been going on, this battle between Frasers Group, which owns 27% of Boohoo, and Boohoo itself, it's been going on since October. And, we've had vote after vote. First of all, Mike Ashley wanted to be made chief executive. That got a big Then he wanted a seat on the board. Another one got a big And the last one that we've just literally had was a shareholder vote to see whether or not one of the founders who is currently on the board should be kicked off the board. So this is Mohammed Kamani, and I was looking at shareholders, and 4/5 of shareholders actually voted in this one. 2/3 of them voted to keep him on the board. So now this is another vote that Frasers Group has tried to action and hasn't managed to get it over the line. Look, you can understand when you look at the share price. It's down by more than 9% in the last month. It's down by 90% in 5 years. You just remember the pandemic when online retailers were going absolute great guns. Well, the market's changed. I don't remember the last time that we had a Boohoo parcel coming through our doors, and I know a lot of people are very much anti-Shein. Well, we get lots of Shein stuff through the doors. We also buy a lot of vintage stuff, so secondhand stuff. But Shein just has value and it has the right stuff. And that's what my teenagers are wanting to buy. Boohoo, in its latest half-year results, had revenue down 15%, while adjusted operating profit fell 10.5%, net debt also up. And Mike Ashley has been taking a look at the playing field. He's been taking a look at the performance of Boohoo and is clearly worried. But with all of this going on, with all of these fights going on, you've got to wonder how much it is taking away from the ability of Boohoo's executive to actually do the job of turning around the fortunes of this company. So whether or not we're going to see any more votes, whether or not that is it, whether we'll have a period of time when the focus can just be on trying to turn things around, change the structure, change the focus to really make this company sing again in some way, I don't know. I would imagine there are an awful lot of investors who are pretty frustrated with how things have been going, but clearly they appear to be willing to give the current executive chance to do something about it.
Were your sound effects based on family fortunes?
Yeah, I think they were. Show my age.
I've just been given a new phone at work and I'm looking for a new ringtone. So I might take your little sound effect, and see if I can work out how, if you're calling me, that's the sound I get from now on. Right, let's just end up with an update on some AJ Bell funds. Danni, I know you recently been talking to James Flintoft, who's our head of investment solutions, because there's been some interesting changes made to what's actually going on inside those funds.
James, thanks so much for joining us. Can you summarise how you approach changes to asset allocations?
Yeah, there's three major steps really. So we like to review the structure of our asset allocation every year, make sure that we're including assets in the portfolio that really we want exposure to in the long term. So to take forward into our strategic asset allocation process, which we re-optimize every year and then monitor throughout the year. So this year we have made some structural changes to the process. We take that into what's called a strategic asset allocation process, which is based around a mathematical model called a mean variance optimizer. We construct an efficient frontier, select the portfolios from that frontier, which is 6 core asset allocations there. Then we look at those portfolios, try to think about the risk inherent in them, what maybe a model can't see within those portfolios, and think about tactical intervention around the edges. Usually that's with really high conviction ideas, but sometimes it is just really making sure that we fine tune the risk in the portfolio as well.
Can you give us a bit more on the structural changes to the process this year?
Yeah, there's 2 major changes really. So firstly, in the alternatives, we've removed them from the asset allocation process this year. So they were historically infrastructure and property. We feel that actually those 2 asset classes aren't giving you the return dynamics and the diversification that you really want in portfolios over the long term. So we do still consider those asset classes as tactical asset classes. So we will look at them, but we think of them more like equity asset classes because inherently that's what they are. So we don't put them into the optimization process, and we won't do going forwards. Then secondly, we've looked at our emerging market in Asia exposure, and specifically around China. Now China is embedded within those 2 asset classes, and it has been for a number of years. We've decided this year that now is the time to be more transparent and offer greater flexibility with our China positioning. So we've broken those 2 asset classes up into China on its own, emerging markets ex-China, and then a developed market Asia Pacific index to make sure that we've really got that ability to dial up and down the risk in China specifically.
Just some of the major themes then surrounding the revised asset allocation this January.
The major themes really inflation and how that impacts the bond portfolio. We feel that there's some specific vulnerabilities in the UK, but some of those also translate into the US. So in the UK, we're thinking about food and energy inflation, the vulnerabilities we have in terms of importing a lot of that into the UK. And we feel that the market throughout 2024 has perhaps lost sight of what's going on with inflation a little bit because there's been lots of political interference, lots of geopolitical events. So it's come into the background a little bit. It's lost the focus. It's got back to target. So naturally, some people aren't looking at it quite as closely. We feel there's maybe a little bit of upside risk building in there. Not necessarily that there's going to be a big overshoot in terms of inflation, but we think there's a potential that markets are a little bit complacent around inflation and we're not being compensated for that risk regarding inflation. So we've wound duration back to make sure that we're not taking too much interest rate risk. So if there is an uptick in inflation, we're not actually getting hit by long duration positioning should interest rates need to rise, or should indeed markets expect that interest rates need to rise as well. So we've really dialed the risk down in the bond portfolio this year.
Let's talk about equity content now. How has that changed?
We've changed the controls a little bit around this, so we now consider the equity content of each portfolio as a standalone equity portfolio in its own right and think about that risk relative to the global equity index. So we've made some changes to the guardrails around that, so you'll see some changes in the portfolio that relate to that. But broadly speaking, the rotation that we're seeing this year is into Europe because valuations are low, the model likes that. And then into the US because we've changed some of the guardrails around that. We feel that we potentially, the portfolios and the optimizer would introduce too much downside risk relative to US markets. So we've just tightened up some of the exposure in the US equity market. And we've also at the same time looked at the concentration within the US market. It's historically concentrated, as are lots of other markets, but specifically in the US, which has performed really well over the last couple of years, we feel that there's risk building. So we've taken the opportunity with the increased allocation to the US this year to introduce just a little bit of equal weight exposure as well, just to dial back that concentration.
Have you made any specific changes to holdings?
A fair few changes there. So there was that iShares S&P 500 equal weight related to the US going in there into the passive portfolios. We've also introduced some synthetic ETFs into portfolios this year for the first time in emerging markets, ex-China and in China. Now we've introduced those because we've assessed the counterparty risk inherent in those types of vehicles relative to what you see in a physical ETF. And actually we've seen that some of the risks are very much the same, if not a little bit better in some of the synthetic products. Because of how the securities lending on a physical product takes place, you are incurring counterparty risk now. Lots of physical products are doing that now because they want to keep costs low, and that's one method of doing so. So the counterparty risk looks very similar with a synthetic ETF. So we've introduced a couple of those because they give us better tracking error relative to the benchmarks that we want to track. On the active side, few different changes. So we've gone emerging markets ex-China, so we've introduced an Invesco fund there as part of that change. In Europe, we've taken the opportunity to assess the blend of funds that we've got there. So we've introduced the BlackRock European Dynamic Fund and the Lightman Fund in Europe as well as part of that blend. The casualty there has been the BlackRock Continental European Income Fund, which, as the name suggests, is an income fund. We've moved that across the income portfolios only and kept the growth portfolios invested in those two new funds for our allocation. Then in China, we've dropped a fund there, the FSSA All China Fund. There's been a reassessment from the research team there. So we've introduced a passive holding in there for the time being in the active and the passive portfolios. And then on a couple of other points around those alternatives, we've removed the Gravis fund that we have in there because obviously we're no longer allocating to that asset class. All these details, line by line, what's going on in the portfolio are available in our broader SAA document that's been released as part of this process, and some of the other material that we've released, so you can study those in finer detail.
Let's end with the outlook then. What sort of market environment are you positioning for?
Yeah, we try not to be too specific with our positioning because ultimately we don't know how markets are going to unfold, but we're just thinking about the risks and the very specific risks in there regarding inflation in the bond markets and then concentration in the US equity market. Now, we don't know how that will pan out, but we're just thinking about the downside risk in the portfolios. We've got a decent history of protecting the portfolios in the bad time. We feel this is another juncture that we could do so, particularly in the bond market where we've brought duration down, we don't feel like there's any adequate compensation for taking long duration positioning. So when we're not being compensated, just don't take the risk, basically.
So that was James Flintoft from AJ Bell. And that's all we've got time for this week. So Laura and I will be running the podcast next week. We'll make sure we've got some really interesting stuff for you to listen to. And I will no doubt be booking up some excellent speakers to join us on that podcast.
So do make sure that you like and subscribe wherever you get your pods, and remember to tell others about it. And you can also get in touch with us. We love to hear from you, your suggestions from who you'd like to hear from on the podcast, topics you'd like us to discuss. You can email us podcast@ajbell.co.uk. And until next time, thanks for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.